Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network. This is part of a series on earnings quality. Earnings quality is how good are the earnings? Is the company good at producing cash flow or gross margin or gross profit using the assets that it puts on its books, the assets that it itself buys in order to run the business? And we've seen that earnings quality tends to be helpful, at least when you look at the past. Nobody knows the future, but in the past, it has been helpful when it comes to selecting stocks. We only have looked at that in the United States so far. I definitely think it's worth looking at that in the context of other countries. But one thing at a time. Now we're going to look at something that is kind of generally part of earnings quality, but it's also a little bit different, which isn't technically or specifically what the quality of the earnings are, but it is how the company treats its owners when it comes to sharing those earnings. And this is about concentration and dilution. So concentrate on concentration because it's worth concentrating on so that you don't get diluted with your earnings and with your ownership. So let's look at the data. And as we've done before, we've taken a wide array, thousands of American companies over the data period that we have available, and we've put them in certain buckets. According to whether the companies are concentrating their ownership versus diluting. Well, what does that mean? Okay, when a company buys stock back from the shareholders, it's decreasing the number of stocks in circulation. So let's say a company goes out there and buys half the stock back. Now there's only half as many shares out there as there were before. But the company is still as big and as profitable and owns as many assets as before. It's the same company. But now each share owns twice the proportion of the company as before because there's half as many shares. So if there's a company that's worth $100 and that company has 100 shares, then it's $1 per share is the worth. Let's say the company goes out there and says, we're going to buy back 50% of the shares. We're going to buy back 50. Let's leave out the fact that they won't have the cash anymore. I don't want to make things too complicated. So now it's a $100 company, but there's 50 shares of it. So those 50 shares are now They own twice as a proportion. They don't own 1%, they own 2% of the company. And that's concentration. Or the company can say, like we saw this recently in the fight over Tesla, when there was a poison pill idea, where they were threatening to put new stock out in order to dilute the value of the company, drinking poison. Or actually making the shareholders drink poison. That's no way to do business. All right, so that would be dilution. So this is concentration and this is dilution. So we put them in these buckets based on whether they're concentrators or diluters, okay? So diluters, strong concentrators here. All right, and then what we say is, hey, let's look at the returns the year after, and let's see how good those returns are based on whether they're concentrators or diluters. And we see that as you're getting less good when it comes to the concentration versus dilution trade-off, the returns are going down. And then in the middle, even worse. That's odd. See, it's not always linear. It's not always neat in the real world. There's theory and then there's the real world. And then, of course, this is kind of back on the pattern. These would be highly diluted. So most of what's going on here is this versus this. So this isn't, what's going on in the middle is not highly predictable, right? So diluters, it really hurts. Strong concentrators, it really helps. The story is kind of muddled in the middle, and that's the kind of detail you need to know when you're making investment decisions. So stock dilution versus concentration makes sense. Companies that concentrate your shares, concentrate your ownership, rather than diluting, rather than printing a lot of extra shares so each one is worth less. That's not good for you. Instead, they recall them and they make each one worth more. And now, when that happens, that can help with performance when it happens in real time. But what we learned today is it helps future performance. In other words, the concentration happens in year one, Well, that tends to help with performance in year one when it's going on. If they're buying them back, that helps. But it also helps next year in general, at least when we look at past data. So that's an important thing to understand. Earnings quality, but also a company that takes those earnings quality and those high quality earnings and says, well, they're yours. So we're not going to dilute away your share in them. And that is part of the picture as well. I hope you've enjoyed this series on earnings quality, and I do hope that you will subscribe to the Eagle Investing Network, which you can do right here, and also share this with somebody else who you think will benefit. I'm Jerry Bowyer. Thanks for watching.